All right, let's get right into it. What a wild ride on Wall Street. On Friday, we saw one of the most incredible turnarounds, I think, in recent memory. The week kicked off with everyone whispering about a tech meltdown, but it ended with this just all out euphoric rally. We're going to break down exactly what happened, why it all went down, and what it really means for you. I mean, just look at this. It's night and day. Earlier in the week, the whole narrative was just pure panic. You had analysts yelling software Armageddon, seriously asking if the AI bubble had finally popped. The big fear was that big tech's massive spending plans were about to absolutely crush their own profits. But then, fast forward to the closing bell on Friday, and it's a complete 180. The Dow smashes through 50,000 for the first time ever, and the S&P and Nasdaq just rocketed right up there with it. So this is the big question, right? This is the mystery. How does an entire market flip from pure fear to pure greed in what, a matter of hours? What on earth changed? That's the billion-dollar, well, actually trillion-dollar question we're going to answer right now. And the answer, really, it all comes down to what I'm calling the $650 billion epiphany. This was the exact moment the market literally rewired its brain on how to think about this whole AI arms race. Okay, so it all kicked off with this piece of news that sent a real shockwave through the market. Amazon comes out and announces this just jaw-dropping $200 billion spending plan. And that's just part of a bigger $650 billion spending spree from all of big tech. At first, Wall Street looked at that and just saw a complete disaster, a huge drain on cash that was going to destroy any short-term profit. And the market's first reaction was quick, and it was brutal. Investors just hammered Amazon, sending the stock tumbling down. The fear made sense, right? I mean, spending that much money has got to be bad for the bottom line, or so everyone thought. But then, somewhere around midday, something just clicked. A whole new idea started to ripple across the trading floors, an idea that would completely flip the entire script on its head. And that big idea is perfectly captured by the classic picks and shovels strategy. It's a really simple concept. Back in the 1849 gold rush, the people who made the most reliable fortunes weren't the guys digging for gold. Nope, it was the merchants who were selling them the picks, the shovels, the wheelbarrows. The market suddenly realized the AI revolution is the new gold rush. And here is the aha moment. That $200 billion cost for Amazon wasn't just vanishing into thin air. It was flowing directly into the bank accounts of the companies selling the shovels for this AI gold rush. That spending is guaranteed revenue for a company like NVIDIA, who makes the essential chips that everybody needs. And just like that, boom, NVIDIA's stock explodes and it pulls the entire market right up with it. But here's where it gets really fascinating. This wasn't just a tech story. Not at all. The rally was so much broader than that, and it signaled something much deeper was going on with the health of the entire economy. Let's take a look. The Dow hitting 50,000, that's so much more than just a big round number. The Dow is made up of these industrial blue chip companies, the ones that represent the real economy. So for it to hit a historic milestone like this, it meant that all that optimism was spreading way beyond Silicon Valley, right into America's industrial heartland. And this chart just tells the whole story perfectly. Yeah, of course, NVIDIA, the king of AI hardware, was up almost 8%. But look at Caterpillar, the company that makes giant yellow construction equipment, a true bellwether for the real economy. It was right there, neck and neck, with a 7% gain. This tells you it wasn't some narrow tech-only rally. This was a broad, powerful boom. And this good feeling wasn't just based on vibes. It was backed up by cold, hard data. The Michigan Consumer Sentiment Index came in and just blew past all the expectations, hitting a 6-month high. What that means is that regular American consumers are feeling confident, they're ready to spend. It pretty much put to rest all those fears of a recession and really strengthened that whole soft landing idea for the economy. So this huge shift in thinking, from being terrified of spending to celebrating it, it created a really, really clear dividing line in the market. It basically sorted every company into one of 3 buckets. All right, let's just lay it all out. In the winner's circle, no surprise, is NVIDIA, the ultimate shovel seller. Then you've got the under pressure group like Amazon, who's buying all the shovels and investors are punishing them for that short-term cash burn. And then you have the companies that were just completely left behind. A perfect example is the automaker Stellantis, which just cratered after admitting its whole EV strategy was a failure. The market was sending a crystal clear message: adapt to this new world or you're gonna get left in the dust. Okay, so we've broken down the what and the why. Now for the big so what. What does all this mean for you as an investor? Well, all the chaos from that day actually gave us two very distinct, very clear strategies for how to think about this new market. So you've really got two main paths. You can go aggressive, betting big on that whole picks and shovels story, and just ride the AI hardware wave. Or you can play it a little more defensively and bank on the broad strength of the real economy that just pushed the Dow past 50K. So the aggressive play is pretty straightforward. You're focusing on the companies that are actually building the guts of this AI revolution. The semiconductor guys, the data centers, the power grid companies. The logic is simple. You are betting on that guaranteed $650 billion in spending. Now the big risk? If big tech's AI dreams don't pay off quickly and they suddenly slam the brakes on spending, these stocks could fall off a cliff. ETFs like SMH for semiconductors or PAVE for infrastructure are good examples of how to play this theme. Now, the defensive play is really a bet on America itself. You'd focus on those classic blue-chip companies that powered the Dow to that big milestone, industrials, financials, and the companies that just reliably pay out dividends. Here, you're betting on that strong consumer and the overall resilience of the U.S. economy. The main risk is macroeconomic. If inflation comes roaring back, that could force the Fed to delay rate cuts, which would definitely squeeze these more traditional businesses. You might look at ETFs like XLI for the industrial sector or SCHD for dividend stocks to get exposure here. And all of this brings us to the ultimate question that every single investor is asking right now. Is this incredible rally actually built to last? Or was this just a one-day sugar rush that's going to fade? Let's weigh the evidence. You know, what's really interesting here is how balanced it is. The case for being a bull is powerful. You've got this confirmed AI spending supercycle, a really confident consumer, and market fear has just collapsed, which you can see in the VIX dropping like a rock. But the bear case is just as compelling. That pressure on big tech's cash flow is very real. We've got huge inflation and jobs data coming next week that could absolutely spoil the party. And that original software Armageddon fear, it hasn't actually gone away. And that really brings us to our final thought. Today, the market threw a huge party for the hardware boom, all paid for by big tech's massive spending. It was a great day to be a shovel seller. But eventually, the companies buying all those shovels, they have to actually prove they can find gold with them. So the question we're all left with is, what happens when the bill for this AI gold rush finally comes due?